Welcome to video 12B on fringe benefits. I'm going to do my absolute best to keep this one short. The past couple have been long and dragged out, and frankly, the production value on them has been a little bit low. But, sometimes you just got to grind through them. Okay, so we're revisiting fringe benefits, not in a technical way, but in a policy-driven sort of way. So employers often provide non-cash benefits to employees in addition to their cash compensation. Things like health insurance, which of course we've talked about, to items that are a little bit more exotic, like the use of a corporate aircraft. So the general rule, as we know, is that this is going to be taxable to the employee on the receipt of whatever it is. Because transfers from employers to employees are almost universally treated as taxable income. And certainly taxable fringe benefits do not differ from that general rule. Employees recognize compensation income on all benefits received unless they are specifically excluded by tax law. And really, you treat those benefits as if they were received like taxable cash compensation. And the employer would deduct the cost of whatever that is and generally speaking, pay the employee's share of FICA taxes on the benefit, and the employee would match, et cetera, et cetera, et cetera. Employees think about taxable fringe benefits because they may prefer a taxable benefit to an equivalent amount of cash if they benefit from some form of employer-provided quantity or group discount that's associated with the benefit. So as an example, we're going to talk about life insurance. Okay, so to be clear, you're not responsible for this specific tax rule, although, caveat, you have a homework problem that involves the computation of the taxable amount of life insurance. You just click on a schedule and do a quick math calculation. I'm not going to hold you responsible on quizzes or in the exams for that material, but the homework problem had enough other good stuff in it that I wanted to assign it anyway. And this life insurance part is just a teeny part of it. In any event, so employees must recognize a certain amount of gross income when their employer pays for life insurance premiums for a policy with a death benefit in excess of $50,000. So as you recall back in the gross income chapter, when you read it, you should have realized when life insurance is paid for by your employer, it's actually tax-free up to $50,000. So the tax law is written in a way that an employer can cover life insurance for an employee up to $50,000. And think of that as kind of the cost to get them in the ground. And that's a good thing. So to compute the annual tax benefit, taxpayers use the following steps. So first, subtract $50,000 from whatever the death benefit is that they signed up for. Then take that excess result and divide it by $1,000. Then multiply that by the cost per thousand of protection for 1 month from the table provided in the Treasury regs. So basically, the IRS pushes out a table that says, look, here's the value. Let's say you had $60,000 of life insurance. Here's the value of that incremental $10,000 of additional life insurance to you. And you just use the value tables. It's not like you have to guess at what that value is. And then you just multiply that by the number of months in the year, which would typically be 12. So you get the monthly amount of that value transfer, and then you multiply by 12 to get the annual amount. And typically that would be better than having two policies. Okay, well, I'll take the free one from my employer all the time, and then I'll go buy an additional $10,000 term life insurance policy on the marketplace. Well, no, that doesn't make any sense, right? It's almost always cheaper to just buy the $60,000 in a single policy. And so in this case, even though it's a taxable benefit, it still is in the employee's interest to go ahead and participate in that benefit. Now, of course, we also know there are a number of non-taxable fringe benefits in which the employee gets to exclude that value transfer from their taxable income. If not all of it, then at least part of it. But the employer continues to deduct that cost when it's paid. So group term life insurance up to the $50,000. Health and accident insurance and benefits. Meals or lodging for the convenience of the employer. Again, only 50% of that is deductible by the employer. Employee educational assistance. So an employer can actually provide for tuition payments for college, for example, for employees under an employee educational assistance program, and that can be tax-free to the employee up to $5,250 a year. Dependent care benefits, so the employer can run a daycare center at the work location. No additional cost services we talked about. That's the airline seats for airline employees. Employee discounts we talked about. We're not going to spend a lot of time on working condition fringes. We talked about de minimis. We even talked about transportation fringe and the moving expense reimbursement, but that's now only for armed forces. So let's say an employer offers to reimburse an employee $200 a month for parking costs. What amount of this reimbursement would be a non-taxable qualified transportation fringe to the employee? Well, in 2017, all 2,400 would be excluded because back then you could exclude up to $250 per month as a qualified transportation fringe. In 2018, the amount that's excludable went up to $260 a month. So at $200 a month, it's all still excluded from the employee's income, but the employer may no longer deduct that item. And then in 2019, the amount goes up to $265. That's excludable, but it remains non-deductible by the employer. Okay, so just so we can see what the difference is between deductibility and not deductible, to make it 1,000% clear, is the after-tax cost, of course, goes down when it's tax deductible. So when the pre-tax cost is $2,400 and you generate tax savings of $504, the after-tax cost of that fringe to the employer is only about $1,900. Whereas, of course, once that becomes non-deductible, it remains at $2,400. So whether or not these non-deductible fringes are going to continue is a question that the marketplace will have to decide. So why provide fringe benefits at all? So let's do a policy example. Brian Mills has a particular set of skills, and St. Clair Inc. wants to hire him. So Brian wants health care from his employer, and the expected cost of health care for Brian and his dependents is $12,000 a year. And let's assume Brian has a marginal rate of 25%, and St. Clair Inc., of course, as a corporation, has a 21% marginal rate. So St. Clair has two choices. They really want Brian because he has this particular set of skills. So they could pay him the wages necessary to cover his health care, or they could just pay his health care directly, right, through a qualified fringe. So let's see how that would work out, starting with Brian. So remember, Brian needs $12,000 after tax because if he pays his own insurance premiums, that's going to cost him $12,000. So if they have to pay him wages, then St. Clair Inc. would have to pay him a wage of $16,315 because Brian then has to pay income tax and employment taxes. So after the payment of those, he would end up with $12,000 in his pocket. Now he could go out and buy that health care. Or they could pay him direct, in which case they would just pay the $12,000 of health insurance premiums directly, and he still gets a $12,000 transfer of value. So under either of these scenarios, he's indifferent. It doesn't matter to him. But let's look at St. Clair. Oh, this is the calculation of how I got to what that wage amount, the pre-tax wage amount was, in case you're a math maven and you really want to know. Okay, so now let's look at St. Clair. So remember, St. Clair would have to pay a wage of $16,315 if they were going to pay him wages to cover that. So let's look at the after-tax cost. Well, they would get to deduct employment taxes. They would also generate savings from income tax. As a result, that should be in brackets. As a result, their after-tax cost is $13,000. Whereas if they just pay that fringe benefit directly to the health insurance company, the after-tax cost is only $9,480. They save almost $3,000, over $3,000 in after-tax cost just by paying direct. St. Clair is not indifferent to this choice and would clearly rather pay that fringe benefit directly than they would pay Brian the wages. Okay, now the deal is most of us do not have Brian's very particular set of skills. And so the burden, or at least part of the burden, can be shifted to us. So let's look how it would work in a hypothetical situation where we have no negotiation power, like Brian did, and instead it's St. Clair with all the negotiation power. Okay, so now St. Clair says, look, I don't care. You're worth 12 grand. I'll either pay you 12 grand directly as wages, or I'll pay you direct. Now, if you look at it from Brian's perspective, there's no doubt he prefers the qualified fringe benefit, because if they pay him wages of $12,000, he ends up after tax only having $88.26, and so now he has to bear the burden of that additional healthcare cost from somewhere else. Whereas, of course, if they pay him direct, he just gets $12,000 worth of value. How about from St. Clair's perspective? If St. Clair pays him directly, then they get an employment tax deduction and an income tax savings. The after-tax cost is $96.17. Whereas if they just pay it direct, it's $94.80. The difference really being the employment tax. So when you think about it, they're nearly indifferent, and they're still better off paying direct. So you can see that under any scenario, between hypothetically Brian has all the negotiation power to St. Clair has all the negotiation power, St. Clair's always at least indifferent to just pay the fringe benefit. Whereas it's clearly in Brian's favor to pay the fringe benefit. So what this means is St. Clair could go to him and say, well, look, because this is better, we don't have to offer you as much in wages. We could actually offer you less in wages, because now you don't have to pick up that nearly $4,000 worth of healthcare insurance on your own. Okay, so just to be clear, in case you ever have to go looking for any of this information, the new Tax Cuts and Jobs Act changed the following starting in 2018. Bicycle commuting fringes are not excludable. It used to be you could pay an employee a certain amount of bicycle commuting costs, and that was excludable. That's gone. Moving, we know, is armed forces only, and we're not going to beat up the other two because we just did. All right, that brings us to the end of video 12B. I hope that was faster.
I don't know who you are. I don't know what you want. If you are looking for ransom, I can tell you I don't have money, but what I do have are a very particular set of skills. Skills I've acquired over a very long career. Skills that make me a nightmare for people like you. If you let my daughter go now, that'll be the end of it. I will not look for you. I will not pursue you. But if you don't, I will look for you. I will find you.
And I will negotiate a fringe benefit package that will kill you.
Good luck.